The 2013 World Silver Interim Report just came out. Let's look at the numbers. As you may guess, in a year like this, the results are a bit mixed, but maybe a bit more positive than they first appear. Starting with supply. Mine production is estimated to hit an all-time high this year of about 815 million ounces. So while the drop in price of silver has hurt producers, it has not slowed down production. Looking at the chart of yearly silver mine production, both total silver production and total silver production from primary silver mines are at all-time high levels. Much of the increase in mine production was offset by a decrease in recycled silver scrap. Overall supply is estimated to be about 7 million ounces higher than last year. Not a huge increase, but it does make estimated supply for 2013 an all-time record high of 1.056 billion ounces of silver. Moving over to demand, industrial demand is estimated to have an increase of a little over 5 million ounces. While it is an increase, it is actually 9 million ounces less than the 2013 forecast in last year's interim report. So while industrial silver demand increased, the actual increase was only a little over a third of the forecasted increase. The drop in photo demand was pretty much expected, with the world using less film each year. The rest of demand has some bright spots. Jewelry demand is estimated to show an increase of about 10 million ounces over 2012. This is a huge reversal, as silver jewelry demand has risen from both the rising cost of gold and laws regarding gold jewelry in some countries. This has caused, in my view, a fundamental shift in jewelry demand, which was in a decline or at best flat, and now for 2 years has spiked up. Silverware demand is estimated to show an increase of about 6%, which is the first increase in 5 years and only the second increase in a decade. Silverware was forecasted to drop in 2013, so this is another reversal. Coins and medallions are estimated to beat forecast for an estimate of about 110 million ounces, second only to the year 2011. Coin demand is often viewed as a measurement of retail silver demand, so the increase in coinage shows retail demand holding and even increasing through the drop in silver price. When you look at the chart of coin sales, it is interesting to note that almost all silver coins were sold in North America and Europe. Implied net investment shows an estimated drop of about 19 million ounces. However, implied net investment is a very misunderstood term, and this does not necessarily mean that actual net investment dropped 19 million ounces. In short, implied net investment is not a measurement of investment, it is a measurement of supply. Let's break that down. The total supply of silver can be counted. However, not all demand can be counted. There is no way to count the physical silver bought for investment that wasn't manufactured into coins. Each year, the total supply and total demand must equal. Therefore, the industry takes the total supply of silver and subtracts from it the demand that can be counted, which is industrial use, photography, silverware, jewelry, and coins. The rest of the supply that cannot be counted is labeled implied net investment. In other words, each year, the industry takes the total supply, subtracts from it the demand that can be counted, and then says, well, we know we had that much supply, and it didn't go into industrial use or coinage, and we didn't bury it back into the ground, so it went somewhere. Therefore, we have to assume it was bought for investment. However, in reality, it could also go into inventories. Actual net investment is a combination of implied net investment and inventory levels, and therefore not easy to measure. There are 2 more charts that I feel are very significant. The first chart shows the delta between supply and non-investment demand. As you can see, the delta or gap between the amount of supply and the amount of silver going to non-investment use is growing and expected to continue to grow. This places pressure on silver investors in that the demand for investment must grow as well to offset this. The last chart is, in my view, the most important one. This shows the yearly increase in cash costs. If you watch my videos breaking down silver costs, then you know that cash costs are basically the cost to produce silver, but does not include depreciation costs, which is basically all the equipment and buildings, and it does not include things like finance costs. The reason why one looks at cash costs is that cash costs show the changes in cost to produce. As I showed in my video on cash costs exponentially increasing, looking back in the mid part of last decade, Cash costs were near the $3 an ounce price. Now cash cost is close to $9 an ounce, meaning that production costs have basically tripled in under 10 years and are still heading up. My videos breaking down the cost to produce silver show that complete cost for producing silver is currently over $20 an ounce on average. And producers that were mining silver for a profit when silver was $9 are finding themselves struggling to be profitable at silver in the low 20s. This helps confirm what I've been saying for a year now. Increase in demand and cost to produce will cause silver to increase in price at a rate that greatly outpaces inflation. But for the next few years, the increase in supply will prevent silver from shooting up dramatically. My personal view is that, unless there is some sort of major economic collapse or crisis, silver will stay in the low $20 range for a while and then increase at a steady pace over the next few years. Thanks for watching.